What is the best home loan program for you in 2023? All right, guys, so 2023 is here and we want to know what's the best loan program for me as a home buyer, whether you're a first-time home buyer or a seasoned real estate investor. So let's get right into it. So the number one best program that you should definitely try to go for in today's market for 2023 is the 3-2-1 buy down. So if you haven't heard of it yet, give it a quick Google. A 3-2-1 buy down is when you are buying a house and the seller will pay or give you credit to have a lower interest rate for the first 2 to 3 years of that loan. So what does that look like? Let's take a look. So a 3-2-1 temporary buy down on a $350,000 loan with someone who has a 700 score, 10% down. So if you were to get a regular 30-year loan, your rate would be around 7.75%. Give or take a little bit depending on when you're watching this video, but in late 2022, that's your rate. In year one, your rate would be 4.75, 3 percentage points lower than today's market rate. So you would start at 4.75 for year one. So comparing that to the 7.75, that's a savings of $681 a month. In year one, you save $8,000. That's almost enough to buy half of a Bitcoin. That's a lot of savings. That might get you a ticket to the Super Bowl. And the beauty about this, the seller pays it. Year two, the rate goes a little bit higher, 5.75. You're still saving $464, 5,000 savings. Again, year three, you could see what's going on. It'll go to 6.75. Your payment goes up a little bit. You're saving $237 a month. So over 3 years, you're saving over $16,000. Guys, just think about what you could do with $16,000. You could pay off debt. You could do so much. You can invest in the stock market. You can, put away for your kids' college. You can go on a nice trip. Whatever you want to do. That's a lot of money, guys. $16,000. You could take the whole family, to Europe for, a few weeks with that. 3-2-1 buy down, definitely hands down the best program if you're looking to buy a house. Again, beauty of it is the seller is going to pay for this. Okay, so this savings essentially is coming out of the seller's pocket. Now, one thing to keep in mind. Well, Roger, how about in year two or year three, rates come down and I refinance? Okay, so this number, the 16,607, is put in an account, which essentially, whatever your monthly savings is, they're taking that chunk from the total, paying the mortgage. So you have an account in your name with 16,607. When you go to refinance this loan, whatever the balance is left in this account, you're going to get a check, cash money, for whatever's left. So if you happen to refinance in a year, 2 years, you don't lose this credit. You're going to get a check for this money. So hands down, the best program. And again, another reason why you should definitely look into buying now before the market heats up again, because in 2023, the market should heat up again once rates come down. So that's option number one. Option number two, the second best loan that you can go for is a conventional loan. Conventional, regular, or high balance or jumbo loan. If you have full documentation, which means you work at a company, you get a W-2, or you have a business and you have a really solid net income, you want to get a conventional loan, you're going to get the best rate with that. But again, I'm not seeing many people do a conventional loan because you could do the 3-2-1 buy down and get a lower rate. It just depends. If the 3-2-1 is still available, of course you want to do that, but the next best option is a conventional loan. But I don't know why you would do that if the buy down is available. The only variable with the buy down is you have to have a seller who's willing to give you that credit. And again, depends on how the market is when you're looking to buy in 2023. If the market gets more competitive and sellers are not willing to give you that much credit, then you might have to just get a conventional loan. So with a conventional loan, you need a good credit score, at least 700. You need to have at least 5% down, which again is not much. And you have to have the income. Your debt to income ratio needs to be around maximum 50, but in some cases it needs to be 45. So again, you want to talk to your loan officer or crunch your own numbers to see what your debt to income ratio is. Very simply put, your income is your income. If you have a salary of $120 a year, you make $10,000 a month. If your new mortgage and all your other debt is $5,000 or less, 50%, you'll qualify for a conventional loan. Option number three, let's say you don't have the best credit or you have a little bit more debt than you'd like. The next best option is an FHA loan. Okay, so there's two parts to this program. So you can get a regular FHA loan on a 1 or 2 unit property. I had a home buyer looking to buy an FHA loan on a 4 unit property and he was looking to live in one of the units. So first of all, FHA is designed for people with maybe a lower credit score. If you have a 660, 680 or below, and you only have 3.5% down, you can get an FHA loan. It has to be your primary residence. Back to the 2 to 4 unit scenario. You can get an FHA loan on a 1 or 2 unit, no problem. However, if you buy an FHA loan, this is a really in-depth analysis, guys. This is really important stuff. Don't waste your time unless you know this. You need to know this information if you're looking to buy an FHA loan that's 3 or 4 units. I had to learn this the hard way, and so did my client, unfortunately, but we got through it. If you're looking to buy a 3 or 4 unit property and you want to get an FHA loan, that property needs to pass what's called a self-sufficiency test. What the hell does that even mean? So let's say you're buying a 4-unit property. You're going to live in one of the units. The other 3 units are going to have tenants, right? You're going to get tenants to live in there. The rent for the other 3 units has to cover the mortgage payment 100%. So let me break it down. Let's say you're buying, my client was buying a $800,000-$900,000 property, FHA, 4 units. His mortgage payment was $5,500 a month. So each unit has to be rented for or have the potential to rent for $1,800 a month. You have to keep this in mind when you're getting a 3 or 4 unit. The other units that you are not living in, whether it's the 3 other units or 2 other units, those rents for those other units need to cover the mortgage to pass the self-sufficiency test. If they don't, you cannot get an FHA loan. Even if you make $1 million a year and you want an FHA loan and it's a $500,000 property and your mortgage is only going to be $3,000 a month, you cannot get an FHA loan, even if you make $1 million, unless it passes the self-sufficiency test. So again, benefits of FHA, 3.5% down, low credit score, okay. High debt to income ratio, okay. It all sounds good. What's the downside? What is the downside to the FHA loan? Why doesn't everyone do it? Well, you have to pay mortgage insurance, which is really expensive. So let me break that down for you real quick. Let's say you're getting a $500,000 FHA mortgage. The monthly mortgage insurance is going to be 8% of that amount. So times 0.008. That's $4,000 a year. So divided by 12 on a $500,000 mortgage, you have to pay your monthly mortgage payment, tax, insurance, if you have an HOA, whatever. In addition, you have to pay $333 per month, every single month, as mortgage insurance. So that's an expensive loan. So that's added to your monthly payments. $333 a month is a big number. So that's the downside. There's always a catch. Nothing's for free. Remember that. It's a very important lesson I learned a very long time ago, and nothing is for free. One other thing to keep in mind, with an FHA loan, not only do you have to pay monthly mortgage insurance, but you also have to pay a one-time upfront mortgage insurance. Now, you don't pay out of your pocket, but when you get a $500,000 FHA loan, you pay a 1.75% one-time fee. Again, not out of pocket, it gets rolled into your loan. So what does that look like? 500,000 times 0.0175. That's $8,750. So $8,750 is going to be added to your loan, which is $500,000. So actually, your loan is going to be $508,750 on day one. When you close that loan, that's going to be your balance, not the $500,000. So you have an upfront mortgage insurance, monthly mortgage insurance of $333. Again, it's not terrible if that's all you can afford. Okay, if you can only get an FHA loan, that is not a bad deal. If that's all you can get. Again, you can always refinance into a conventional loan. You can work on your credit, get out of that, get into a regular loan, and then you're good. Okay, the second part of the FHA loan is now we're offering down payment assistance. So instead of the 3.5% down that you would have to pay, you have no down payment. Okay, no down payment whatsoever. You just have to pay for the closing costs, 0 down. Again, there are some income limits and things like that, but they are available to those who qualify. So nothing down, FHA loan for the 96.5%. You have a second loan for the other 3.5%. So you have 2 loans, which together are 100% of the price of the house that you are buying. Okay, the next best loan for 2023 is the bank statement loan. I love this loan. I have personally used this loan to buy a property in the past. The bank statement loan is designed for people who are self-employed, independent contractors, or business owners. Okay, so you can own any kind of business. If you're a real estate agent, you could be a plumber, you can be a loan officer like myself. If you're independent, have your own business, the bank statement loan is the best loan, and here is why. The bank will take your last 12 to 24 months of bank statements, add up all the deposits, divided by 12, deduct an expense ratio, and that is your income. So that sounds really confusing. The premise of this loan is most business owners have too many write-offs. I own a business, and in the first couple of years, I had a lot of money coming in, but I had a lot of expenses. I had a lot of write-offs. I didn't want to pay a lot of taxes, so I wrote everything off. So on my tax returns, it even showed maybe a low number or even a negative, like the business lost money that year. For people in that situation who have too many write-offs, the bank doesn't even look at your tax returns. They don't even care, okay? So let's say you've been a real estate agent for 3 years. First couple years in business was pretty good, but you had a lot of write-offs because it's a new business. So you can't get a loan with your regular tax returns. However, you can get a bank statement loan. As a real estate agent, you were closing maybe 2 deals a month and you're depositing $25,000 per month over the last year. So 25,000 times 12, 300,000. So you brought in $300,000. Now the bank deducts an expense ratio. So that is, hey, you're a business owner, you have to have some expenses. A business like a real estate agent is not going to have a ton of expenses, to be honest, because you go out, you sell houses, you don't even need a fancy office. You might not even have a fancy office. You pay for maybe some marketing material, business cards, things like that, MLS memberships, but you keep a big portion of your income. So the bank will deduct 20% of your deposits. So you keep 80%, so times 0.8. So we've deducted the expenses, we divided by 12, $20,000 a month is what's left on average over the last 12 months after the expenses are taken out. So even though your taxes show a negative number, you still have $20,000 a month in income that the bank will give you. Again, the only downside, you have a higher interest rate. But would you rather have a higher interest rate and a higher payment, or would you rather pay a bunch of taxes and then have a lower interest rate? So you got to do that calculation yourself, which makes more sense. But I love this program because you can do as little as 10% down, usually up to $1.5 million. Okay, the last program that I love for 2023 is the DSCR program. Dog, Sam, Charlie, Ralph. What does that stand for? What the hell even is it? It's basically the DSCR is a loan for investors. You can have a zero income, no income. As long as you have the down payment and you have a good credit score and you have reserves, you can get the DSCR program, okay? So just like the previous program, you need bank statements and things like that. You don't need any of that. Sometimes you need some real estate experience, but a lot of times you don't even need that. All you need is 20 to 25% down payment. And the way that loan works is very simple. Let's say you put 20% down on a house. Okay, it has to be an investment property, cannot be your primary residence. So you're buying an investment property, you have 20%. Let's say the monthly payment on that is going to be $3,000 a month. If the projected rent is $3,000 and your mortgage is $3,000 and it covers by $1, not even by a dollar, it could cover by a penny, it could be 3,001 cents as the rent, and your mortgage is $3,000, as long as it covers, you got yourself a loan. Again, like the previous loan, the only downside is the rates are a little bit higher than a conventional loan, but again, no income required whatsoever. No pay stubs, no tax returns, no bank statements, nothing. Okay, well, just the bank statements for your down payment, but that's it. So again, the only other downside is, let's say the rent doesn't cover the mortgage. Your mortgage is $3,000 a month. However, the projected rent is $2,700. It doesn't qualify. How do you get it to qualify? There's a few different ways. You can choose to do a 40-year loan. By doing a 40-year loan, your payment comes down. Okay, the goal is to get it down to $2,700 so that it passes the DSCR test and you get yourself a loan. You can make it a 40-year loan, you could do interest only, or you could put a higher down payment. So essentially, whatever that rental figure is, you want to try to get the payment down to that number. So if the rent is here at $2,700, you want to get the payment down to $2,699, you got yourself a loan. So very, very easy loan. It's all based on the appraisal. It's all based on the rent that's projected, which the appraiser does as well. So that's all that this loan comes down to. Again, no income. Okay, so just to give you a little more background, you have to do a regular appraisal. So if you're paying $700,000 for a house, it has to appraise for $700,000. And then in addition to the value, the appraiser will give a rental value as well. They'll say, hey, based on comparable houses in the area, this property should bring in about $2,700 a month in rent. The bank will use that number as the target. Then your goal is to get your payment to $2,699. You got yourself a loan. So I hope this helps. I hope this was a helpful video for you guys. I hope you guys continue to build wealth in 2023 through real estate. One of the best and most proven ways to build wealth for generations to come is through real estate. So hope you enjoyed. If you have any questions, you can leave a comment. You can email me below or schedule a call. Happy to help. Happy to answer anyone's questions. If you're legitimately looking for a loan officer to work with in Arizona or California, I'm licensed in both of those states. Happy to help you out in that situation. If not, hope you guys like the video. Hope you find it valuable, and I'll see you next time.